Good morning, everybody. Welcome to our morning meeting. And that's the usual beginning that you guys can expect. So thanks for joining. Let's dive right in to getting ourselves prepared for this market today. We'll talk big picture. We're going to look at the risk monitor and how it changed last week. We're going to go over our highlighted group of the week has to be cannabis. I'll talk about that real quick. And the number one stock chart on my desk this morning is going to be Tesla, and we'll go over that. We'll break it down. So as always, this is a virtual hedge fund experience. You're the portfolio manager on the desk joining me in the meeting. That means you're the risk manager of your own assets. Figure out what we're sharing here. Figure out how it fits your risk tolerance, your goals, and then execute accordingly. All right. First order of business. Hope you had a great weekend. Quick tribute to 9/11. Let me just say one thing about it, and then we're going to get on, move on. Okay. I was in Manhattan when it happened. I was the only guy in my office dealing with phone calls that only came in for the first 10 minutes at the top of every hour. Okay. It was total mayhem. It's something to remember, but I get just sick and tired of all the people making money off of it. It really makes me like want to puke. Okay. So it happened. We were there. I dealt with it. Couldn't make phone calls, literally couldn't make phone calls except for the top of every hour. I couldn't reach my parents in Westchester, New York. I was in the thick of it in Manhattan in Midtown. Okay. But I could call people in California. It was bizarre. Can you imagine living through that? When you think of how much you access your phone now, it was kind of crazy. It was a horrible thing. I think we missed an opportunity when we rebuilt those towers. Obviously, all of those decisions on how to rebuild the towers, they just missed it. The obvious and easy answer was to build the towers exactly how they were, one story higher. Let's move on. Risk monitor has changed to yellow. So the risk monitor follows. Now we're talking big picture of the stock market here and how we're going to execute going forward. The risk monitor turned yellow for a couple of reasons. The first being that the sell-off, the test of the risk monitor green signal is deeper than we normally want to see. Right there, there's reason for caution. But on top of that, we have 10 indexes we follow that drives the risk decisions. 9 out of 10 gave us the risk on entry point a few weeks ago. The one that didn't was aggressive growth, innovative growth. We call it IBD 50. You could look at the ARK innovation, whatever you want, but the IBD 50 didn't do it. We had the risk on opportunity in treasury bonds, but we didn't take it. Not putting money in treasury bonds. Okay. I've said to you, that's kind of like the loss leader. I'm not looking for treasury bonds to go up a lot. I'm just looking for treasury bonds not to make new lows. If they can stay in a range, which means rates have peaked, that's fertile ground for equities to move higher. Okay. What happened last week is the depth of the test of that new risk monitor green signal was a little bit deeper than I want to see, and it tripped the stop on the small cap index. So we sold small caps. That went to cash. Okay. We had a couple other stops hit, so we raised a little bit of cash. So now we're sitting with some cash on the sideline, and I'm only going to put that cash back to work if the risk monitor goes back to green, which would be really a follow-through day that broke the market out again, right? We start moving higher. I could put some of that cash back to work. So real quick, looking at the S&P, nothing wrong with this pullback. It's a breakout and a pullback to test. We take out the lows, it's over. Risk monitor will go red. We hold here and move higher and go back above the high of the original risk on day. That'll be a follow through, and I'll add some of my cash. Risk monitor will go back to green. I'll put some cash back to work. Okay. Here's the small cap index that was just a little too deep. And you could have given it an extra day. And I shared with you guys, there was two different ways to handle risk monitor going to yellow. I could either cut every position down an equal amount, or I could cut the weakest. So I cut the weakest, which was small caps. The reason I did that is if you look at the market this year, the Magnificent Seven are carrying the market. Let's don't make this harder than it is. Tesla, Amazon, Google, Nvidia, Microsoft, Apple. What am I forgetting? Meta. Those are the seven. Those seven are carrying the market. And it's almost as if they're handing the baton off to another one of those seven on a constant basis throughout the year. So for a while it was Nvidia. Now the baton's being passed off, and it may be Tesla. We're going to look at that chart in a minute. So if I put capital back to work, if the market can withstand the selling and start to move higher again, the capital I'm going to put back to work is in the big cap tech stocks. I can either own more QQQ and SSO, so QLD and SSO. I can increase the size of my index positions, or I could own some of the Magnificent Seven that are giving risk on entry points. It's however you choose to do it. Okay, let's look at the top 4 of the 7 names that are giving entry points. And let's highlight, I'm just going to show you real quick. So here's Amazon. Okay, just gave a risk on entry on Friday. Meta had a little bit of a shakeout, and so we're out of it right now. But if it holds up here, I'd like to own Meta again. Okay, so we highlighted this last week, and then it had a bit of a shakeout on some dubious news. Okay, couple of tails, but if it takes out that green box, I could see being long that again. Google is in the driver's seat right here. It looks great. Okay, and then let's talk about Tesla this morning. Tesla's the highlighted chart of the morning for me. Okay, this is the highlighted stock of the morning. First of all, Morgan Stanley came out and upgraded the stock, so the stock's going to be up, I don't know, 6, almost 7% at the open. Okay, what that's going to do is break the stock out of this downtrending channel that goes back to 2021. This is November of 2021. Okay, now we bought Tesla down in here. Okay, caught that rip, exited. Okay, we traded it again right here. We exited real quick. Now, if it comes out of that downtrend and closes the day in that green box or higher, I'm going to want to own Tesla. Bottom line, let's remember that Tesla is not a car company. It's a technology company that's cornered the market on EV charging, on all kinds of charging. They've cornered the market. It's like the Betamax VHS story all those years ago. It doesn't matter if there's a better charger out there, and there may not be, right? It's the biggest gorilla in the space that's locked up the space. That's this company. Now, on top of that, it's an interesting story today or over the weekend. The biggest bottleneck, the biggest issue, one of the biggest issues with EV and all this type of stuff is lithium, right? We've talked about this a lot. Lithium, there's an issue, not enough. It's a bottleneck, all that kind of stuff. It looks like the U.S. has stumbled on a massive, massive lithium find. The border of Colorado and what was some other state, I can't remember right now, right? It's right in there. It's massive, easy to mine, bigger than what they've got down in, where is it, Bolivia or Argentina? Okay, is it Bolivia or is it Argentina? Bolivia, yeah, bigger than the salt flats in Bolivia. Just to put it in perspective, it's about the Oregon-Nevada border. It harbors a colossal 20 to 40 million metric tons of lithium. The Bolivian salt flats, which is the largest to date, has 23 million tons around, just to put it in perspective. Okay? This is why I have no interest in investing in lithium. because there's going to be more fines. This is why lithium stocks look terrible and they keep, they keep selling off. Okay. But what's beautiful about that is that one of the biggest bottlenecks is opening up, as you could expect it would. When there's demand for a hard asset, they go find the asset. That's what's going on. So technically speaking, if it breaks out today, it would be stock that I'd want to own. Fundamentally speaking, it's the dominant player. It's a technology company and all those other things. And on top of that, one of the biggest bottlenecks in the space seems to no longer be a bottleneck. So going back to the risk monitor, it's yellow. I'm cautious. I've raised some cash last week. I'm watching to see what happens. Market breaks down. It goes red. I raise a lot of cash. Market holds up here, goes higher. I put cash back to work and probably in the top names or just simply increasing my exposure to the big cap tech stocks. Whatever I've taken out of small cap, that's probably where I'll go. If you want a second tier name of ideas that look interesting, there are ways to make money this year in specific groups. Okay. Energy stocks have been great. And I always kind of chat with you guys on the desk. How much can I own? I don't know. I own a lot of energy through the 3 ETFs, and I'm kind of content with that. Oh, let's call it 4. I also own the pipelines. So that's the way I'm playing it. I think the drilling stocks look compelling. Patterson, Helmerich and Payne, Patterson are the 2 onshore guys. Rig and Diamond are the offshore guys. They look interesting. They look compelling. I could see adding that. Now let's shift over to the highlighted group of the day, of the week last week. You have to highlight, of course, cannabis. So let me break it down for you, chapter and verse, real quick. There's only 3 ways I want to play cannabis right now, and I'm only using a quarter of the capital that I would ultimately commit to cannabis. Okay? So let's just do this real quick in case you've already heard it. I've been talking about it a lot last week, but if you missed it, here's the bottom line. HHS letter already out recommending rescheduling. We're waiting for the DEA letter to come out to confirm it or argue with it. We don't know. We're waiting for the Justice Department, Merrick Garland, to come out with their memo. Okay. And we're waiting for some type of political safe banking, whatever act. Okay. Those are the 4 things that we're looking to happen probably within the next 12 months. Okay. HHS set it off. Wall Street Bets is talking about cannabis again. These stocks are starting to go up. I want to caution you and remind you of a couple things. Number 1, I do own MSOS. It's a swap asset. Nobody knows how it's going to actually perform if, let's say, we woke up Sunday morning, we woke up Monday morning, and Sunday night, Merrick Garland's letter comes out along with the DEA, both agreeing it's time to reschedule to S3, right? And there's some Safe Banking Act passed, and everyone agrees it's time to turn cannabis into a real business, right? Theoretically, a lot of these stocks won't open. I mean, it'll be up 100% or more. I mean, just explosion. MSOS is a swap. If you read the fine print, Advisor Shares has a deal with their counterparties. The counterparties do not have to own the asset. Bank of New York Mellon is the referee. At the end of each day, they tell Cowen and the other counterparties how much cash they have to move across the ledger to Advisor Shares when these stocks go up. When the stocks go down, Advisor Shares sends cash over the other side of the ledger. It would not be surprising to me if the developments in cannabis happen faster than we think, catching the counterparties off guard because they don't own enough of the underlying or any of the underlying, and they can't deliver. Force majeure. Go like this. They'll come up with a price. They'll swap the cash, and it may be over. Now, it doesn't mean you won't make money on that, but it would be perhaps very frustrating because you wouldn't own the asset. That is a risk. It's a small risk. I don't know how to manage that risk, so I have a piece of my capital in MSOS. But then I have two other investments that are real, I believe, and that will benefit significantly. One is IIPR, which is the cannabis REIT. This was the #1 investment in the cannabis space the last time cannabis stocks skyrocketed. And I think it'll be the #1 idea this time at the beginning of the move, if it's going to happen. The reason is simple. They actually own real estate. That's it. They own the real estate, the grow facilities. Okay. One of the concerns for them, the company right now, is that their tenants, the US MSOs, that are going through a brutal bear market in cannabis right now, right, don't have the cash flow to service the lease. Gets rescheduled. The very first thing that happens is that all that cash flow drops to the bottom line. 280E, right? So IRS 280E, it's onerous. It reduces cash flow dramatically for US MSOs. If it gets rescheduled, 280E no longer applies. Cash drops to the bottom line. The first thing they're going to do is pay their leases. I think that would reflect in the stock immediately. The company trades on the New York Stock Exchange. Anybody can invest. You want to get involved in cannabis? This is the way to do it. Some brokerage firms don't forget, they don't let investors buy MSOS. You can't buy, stocks on the Canadian Stock Exchange. A lot of people. Institutions aren't going to go buy stocks on the Canadian Stock Exchange, but they'll buy this stock hand over fist to get involved in the play. They did it the last time. I think they'll do it again. You want to go out 5 or 10 years and tell me there's other names that'll perform better? I don't disagree with you. But at the beginning, that's the place to have the money. Most liquid on the New York Stock Exchange, immediately benefits from reschedule. And the second company is, I think, clearly now the best run Canadian cannabis company is Tilray. Hands down. Revenue up 20% last quarter. They've been hovering around break even for the last 4 quarters. And while all the other cannabis companies, it seems, in Canada are going bankrupt, are diluting shareholders to nothing, right, and barely surviving, 20% revenue growth, diversifying the business, able to survive in the worst winter in cannabis you could ever imagine. And they have their tentacles all over the U.S. So if there's a change, they're going to be able to act. I think management's proved themselves, and I always like investing in smart management. Tilray is the way I would do it, and it's liquid. So at the beginning of this, everyone says, well, it gets rescheduled and they'll uplist these companies that are on the Canadian Stock Exchange. That uplisting will take months. And at the beginning, what'll be uplisted are going to be the stocks that trade on major exchanges that are liquid. So that's the first place to go for me. Okay. And one simple way to do this is to book profits from the last couple of weeks in MSOS. If you want to book profits and go buy calls that go out a year, it's a lottery ticket. You buy them out of the money and you walk away. Either you make a fortune or you lose that money, but it's the house's money because you've made money in the last couple of weeks in the stock. And then you don't have to worry. DEA comes out and says, we don't think it should be rescheduled. These stocks drop 50%. Okay, so you took some of your profits the last couple of weeks and you rolled them into calls and you lose that money. So what? You took a shot. It's not your money, it was the house's money. That's a conservative way to do it. If everything happens the way we hope in the next 12 months, those calls could come in, huge. So those are my thoughts on cannabis. Risk monitor yellow. Got cash in the portfolio. If this pullback holds and the stocks go higher in here, I'm looking to add some of the bigger cap tech names to the portfolio. Okay. Just share with you the 3 cannabis investments I would own, and Tesla is the #1 stock to follow on my desk this morning. Okay. Hope you all have a great trading session. I look forward to working with all of you at 9:30. We'll look for our day trading strategy on the S&P to see if we can get some day trading money to work. There's 1 trade in the morning, 1 trade in the afternoon day trading. That's it. If you look at the playbook, that's all there is. There'll be a setup in the morning. We'll get on it. We either get paid or we don't. Then there's no more trading until the afternoon when another trade may or may not show up. That's smart trading with the ARMR investing way. Everything else is noise. Every now and then we'll miss a big up day. It's okay. Statistically speaking, There are just so many plays in the playbook. We're looking for those big plays. We get them, we make money. We don't get them, we don't trade. And we focus on the rest of our portfolio. I'll see you all on the desk at 9:30.